Today, we will talk about Bear Stearns, its collapse, bailout, winners and losers. Bear Stearns was a global investment bank located in New York City that collapsed during the 2008 financial crisis. The bank was heavily exposed to mortgage-backed securities that turned into toxic assets when the underlying loans began to default. Bear Stears was ultimately sold to JPMorgan Chase at a fraction of its pre-crisis value. The Bear Stearns Company was founded in 1923 and survived the stock market crash of 1929, becoming a global investment bank with branches around the world. Competent management and risk-taking saw Bear Stearns continue to grow with the global economy. It was one of the many firms to embrace Louis Ranieri's securitization of debt to create new financial products. By the early 2000s, Bear Stearns was among the world's largest investment banks and a highly respected member of Wall Street's pantheon of investment banks. The hedge funds using these strategies posted massive losses that required them to be bailed out internally, costing the company several billion upfront and then additional billion-dollar losses in write-downs throughout the year. This was bad news for Bear Stearns, but the company had a market cap of $20 billion, so the losses were considered unfortunate but manageable. With insufficient liquidity to open its doors, Bear Stearns approached the Federal Reserve Bank of New York for a cash loan of $25 billion. When that was denied, JPMorgan Chase agreed to buy Bear Stearns for $2 a share, with the Federal Reserve guaranteeing $30 billion in mortgage-backed securities. The final price was ultimately raised to $10 a share, still a sharp drop for a company that had traded at $170 a year earlier. The illiquidity that Bear Stearns faced due to its exposure to securitized debt exposed troubles at other investment banks, as well. Many of the biggest banks were heavily exposed to this sort of investment, including Lehman Brothers, a major lender of subprime mortgages. By 2007, Lehman Brothers attempted to unwind its positions by selling stock and decreasing leverage. However, investor confidence continued to bleed out. After a failed takeover by Barclays and Bank of America, Lehman Brothers declared bankruptcy. Here are 5 key takeaways. 1. Bear Stearns was a New York City-based global investment bank and financial company that was founded in 1923. It collapsed during the 2008 financial crisis. 2. Prior to the financial collapse, Bear Stearns was one of the most well-regarded financial institutions. 3. By 2008, the firm's flagship hedge funds were overexposed to mortgage-backed securities and other toxic assets, which had been purchased with a high degree of leverage. 4. The company was ultimately sold to JPMorgan Chase for $10 a share, well below its value before the crisis. 5. The collapse of Bear Stearns precipitated a wider collapse in the investment banking industry, which also took down major players like Lehman Brothers. Hope this would help. Thanks for watching.